friends, such as you all know the names well, Marty Shumway, Tim Knobloch, and new members, Hardy Murchison and Ray Walker of Encino Energy. And we're honored that Vice President Mike Pence is actually going to come to our meeting tomorrow. Obviously, that's pretty cool, but it brings some challenges that we will, I'll talk about here in just a few moments. But following today's presentations, please join us in supporting the Oil and Gas Producers Fund at the Pike reception starting at 4:30 in the Presidential Suite on the 7th floor. A suggested $100 contribution to the Pike will grant you access and give the opportunity to interact with the Ohio General Assembly members. The President's reception begins at 5:30 this evening, so don't miss the opportunity to mingle, fill up on heavy hors d'oeuvres, and then go have a gluttonous dinner and drink, to complete excess before tomorrow's sessions begin. The most important thing, though, I can tell you is, as I mentioned Vice President Pence earlier, and you will be reminded of this throughout the day today, you have to be through security tomorrow by 11 a.m. There's only one way into the hotel tomorrow. It's through the main entrance. All the side entrances will be blocked, including this one back here. Basically the hotel will be locked down. You saw security maybe if you were in here a little bit ago come in. I really fully expected that they were taking me out and not wanting me to be, the opening speaker here this morning, and they were going to drag me out of here in chains, kicking and screaming. But again, we just have to be cognizant of our guests and what security concerns that they have. So please be patient. That's the other thing I'd ask of you. We're just not used to this. So as I said, access will be limited. So your patience will be greatly appreciated. Finally, I would be remiss, excuse me, if I did not thank our sponsors. You'll see a sponsor listing up through the hallways. These folks sponsor not only this particular meeting, but they sponsor every meeting this association does for the most part. And, without them, we just could not make something like this happen. So please, when you see one of our sponsors, thank them, do business with them. That's how you really thank them. But please, just walk up and say thanks. Our staff. You don't pull off something like this. We have a very small staff at the association, but even with that small staff, they're accommodating over 700 people for this meeting. They pay attention to every detail. They worry about everything. They worry about the little things, the big things. They want you to have a great meeting, and man, it takes a toll, but please stop and thank them because they deserve it. And finally, I'd like to thank you, because without you all, this could not happen. We wouldn't even need this organization. So this is just so important that you all participate, that you all support the association as you've always done. So it's great to see you here. You make us strong and this association possible. And I also would like to say this association, because of you, because of its members, we have stayed together as one association for this state. That's the conventional producers, the shale producers, all the other industry participants. And I can't say how much that means. It's very, very much a rarity in this industry, but we've been able to do it. And by God, we'll strive to continue that continuity, and we'll continue to grow based on that. So without further ado, let's get this party started. Jackie Stewart.
Good morning. Let us begin with the safety minute. In case of emergency, please exit the doors to the rear, turn right, and exit the building into the parking lot. Also, please silence your cell phones. Thank you for your consideration. Our first presentation today is from Martin Shumway, who will be providing the annual DeBrose Memorial Report. Mr. Shumway has been involved in the resource industry for most of his career. He has more than 20 years of experience in the mining and petroleum industries and has extensive experience with both exploration and development of oil and gas properties in the Appalachian Basin. He has completed numerous reserve evaluations, field studies, production studies, and geological evaluations of petroleum properties. Mr. Shumway is a professional engineer in Ohio and also a certified petroleum geologist. He earned both his bachelor's and master's degrees in engineering from The Ohio State University. Mr. Shumway currently serves as a technical officer for Locust Bio and Energy Solutions, focusing on business in the Appalachian Basin. Please welcome to the stage Marty Shumway.
Good morning. It is my pleasure and privilege to prepare this report and present to the members of OOGA. A couple quick words. This presentation is a summary of the Ohio Department of Natural Resources data. Their data that is in a phenomenal database that, in my experience in other states and country regulatory agencies, is one of the best and one of the most complete data sets out there. So this presentation and these kinds of studies would be not possible without ODNR's great effort that they've had to construct a database that's both functional and usable with useful information. So thank you to ODNR. And then I'd also like to thank my employer, Locust Bioenergy, for sponsoring my presentation and allowing me to take the hours that it took to put it together. So with that, we'll get started. 2018 oil and gas activity in Ohio. This is a pretty data-heavy presentation, lots of tables and charts. At the end of the presentation, OOGA will post it on their website, so it'll be available for everybody. I apologize for any errors and omissions. When I put this presentation together, I try and honor the data as it is in the database. I rarely make any changes unless there's gross errors. So this is really a culmination of what's been reported over the year. So today we're going to talk a little bit about general overview of historical Ohio oil and gas production, permit and completion summaries that were reported to the state, operator activity, footage drilled, number of wells, activity by county. We're going to take a look at initial production that was reported with completion reports, and then we're going to look at the change of owners that occurred over the year, and then do a quick look at production summary, looking at 2018 production data, and then a real quick look at the Class 2 injection well summary, volumes disposed of in the state of Ohio this year. So Ohio oil and gas production, a lot of people don't know this. You know, since the 1860s, more than 275,000 wells have been drilled. Today, there's more than 50,000 producing wells that are in 49 of 88 counties in Ohio. History of Ohio wells drilled by year and reservoir, beginning in the late 1800s, the Northwest Ohio Lima, Indiana fields were developed, the Trenton Play, and then following that in the early 1900s, the Clinton Play, the Clinton oily plays were being developed. And then in the 50s and 60s, the hydraulic fracturing in Morrow County came online and opened up a whole lot of additional locations to drill, primarily in the Clinton sandstone. In the late 70s, early 80s, the Clinton Play really took off, and over 5,000 wells were drilled annually for several years, taking advantage of the federal tight gas credits. Since then, there's been a kind of a conventional production has continued to hold fairly steady with a couple jumps and blips and new things, but there's been, other than the Utica Shale, there's been no real new plays developed in Ohio for some time, although there is plenty of work to be done. Some of these pictures are a little old. I apologize for that. These are probably a couple years old, but just showing some activity around the state. Permits and completions, 2013 through 2018. So this is just a summary looking back. In 2018, there were 493 permits filed to drill, which is a change of negative 47% from the prior year. Completion reports filed, 408, which is a 41% decline in completion reports. Plugging permits were up a little bit. And we're going to talk more detail about the permits and completions, and I've got a couple, those numbers, got a few more things to say about those. 2018 completion. So of those completion reports that were filed, this is the breakdown of the status of those wells. So 336 of them were producing wells throughout the year, so that's over 80% of the total drilled. Those completion reports filed, 36 of them were not drilled, a handful of them canceled, and other things like that. But we're going to focus on the ones that were drilled and producing for the most part. Permitted formations in 2018, 335 Utica Point Pleasant wells were permitted, 60 Clinton wells, which is a lot more than last year, and then a handful of Knox and Rome and a couple other tests, a couple Brea wells, a couple of Marcellus wells. So overall, of the 493 permits issued, there were 50% less permits issued in 2018 than 2017, and Clinton permits were up 67% last year. Completions, where were things, completions and permits and plug? The blue stars are the completion reports that were filed. The yellow are the permits that were filed, and the red are the plugging permits. So pretty good distribution across the state. Obviously, most of the completions are in Southeast Ohio. Activity by month, again, just breaking it down, permits and when the activity occurred. The rest of these aren't going to include the 37 completions that were not drilled or canceled. So, just a distribution of how they were spread out over the year. Operators completing wells by year. Again, this doesn't include the not drilled and canceled status wells. But as you can see, there's been a pretty steady decline since 2008 in the number of operators completing wells. And in 2018, there were 38 independent operators that filed completion reports, versus in 2008, there were over 180 operators that filed completion reports. Wells completed type, taking a look at the breakdown, horizontal, vertical, and directional. There were 333 horizontal completion reports filed and 35 vertical reports. Completions by deepest formation. So this is showing where most of the horizontal drilling activity occurred. And again, most of that activity is in Monroe, Belmont, Jefferson, Harrison, and that portion of the state. There up in Ashland and Richland County, there's a couple horizontal wells. Those are wells drilled by Columbia Gas Transmission in the storage field. That's the overall distribution of the horizontal wells. Vertical wells, again, by deepest formation. So the bulk of the wells drilled were Knox wells, vertical, 10 Knox wells completion reports filed, and 7 Clinton sand formation reports were filed. And as you can see, they're spread out pretty uniformly across the oil and gas producing parts of the state. Completions by month, again, just looking at the completions horizontal versus vertical, you can see when most of the reports were filed. The blue are the horizontals, and the orange is the verticals. 2018 completions, top 10 counties. So this is by number of wells. So as you can see, Belmont and Monroe County are at the top of the list again, followed by Jefferson County. So in those top 3 counties, only 2 of those wells were filed as vertical completions, and the rest of them were horizontals. So these top 3 counties on this list include 63% of all the completion reports filed in 2018. A little graphic showing the completions by county, horizontal and vertical wells. And again, Belmont, Monroe, and Jefferson are 63% of the total completions filed. So the top 12 most active operators in 2018, and this is by number of wells drilled. Leading the group of operators this year is Ascent Resources Utica, and they filed 70 completion reports in 2018, which is just a small decrease of about 10% over last year. Following Ascent was Gulfport Energy Corporation with 45 completions, and then Antero Resources with 39 completions. Antero's activity is up about 75% over last year. Most active operators by footage drilled. So again, Ascent Resources is responsible for 20% of all footage drilled in the state last year, and that's about a 10% decrease over last year. Rice Drilling is second on the list with 750,000 feet drilled, and it's almost identical to what they did in 2017. Gulfport Energy, about the same, and they're about a 10% decrease over 2017. So the top 12 operators in Ohio are responsible for 96% of the total footage drilled in the state last year. Most active counties by number of wells, again, looking at Belmont, Monroe, and Jefferson up at the top of the list. Most active counties by footage drilled, again, Belmont, Monroe, and Jefferson at the top of the list. Those three, the top 12 counties on this list account for 99% of the total footage drilled in 2018. A little bit of a decrease in drilling in Belmont. Monroe was a big increase in drilling, and Jefferson was about the same as the year before. Footage and wells by year. So this is a little bit of a summary looking back to 2004, and seeing that in 2018 we drilled about 6.6 million feet, which was drilled in 371 wells. Interesting to note here, the increase in the footage per well over last year, about 17,500 feet is the average footage per well, and that's the measured depth of the wells. The other thing to note on this table is the average IPs that were reported by operators. 2018, it's about a 50% increase in IP as reported, up to 13,700 MCF a day. Average IP for oil is down about 50%, and it's 120 barrels per day. Interesting to note on here, looking back to the lowest footage drilled in Ohio was in the year 2011. It was about 1.8 million feet, and we're at 6.5 in 2018. Top 12 owner changes by number of wells. So ODNR tracks change of owners in their database, and so pulled out what the sales were or change of owners that were recorded by ODNR. The biggest change of ownership was a sale of NGO Development Corporation wells to M&R Investments, which encompassed 477 wells, and then the transfer from Verco to Triad, Belvoir Energy, and a handful of other transfers that occurred. The top 12 owner changes last year were about 45% of the total owner changes in 2018. Taking a look at change of owner wells by year, this year was quite a bit less than last year. Last year was a big change of ownership. M&R Investments had some big acquisitions in 2017. 2018, less so. We had about 2,965 total wells transferred ownership last year. So we're going to take a look at IPs, top 12 counties by average IPs. At the top of the list this year for 2018 is Jefferson County, 41 completions filed, and the average IP was 22,698 MCF per day. What I did on here to take a look and compare them with the IPs that were reported was combined and came up with an MCFE, an equivalent gas production, using a ratio of 20-to-1, which is approximately a price equivalency. So these are sorted by the equivalent number, and Jefferson County leads the list, followed by Harrison, Guernsey, and Belmont. Top 12 operators by average IPs reported. This takes a look at the IPs that are reported by each operator and looks at the average IPs. Ascent Resources leads the list on this one with 69 completion reports filed. Their average IP for oil was 138 barrels per day and 18 million gas. Again, this is sorted by gas equivalents on a price ratio. So the top three are Ascent, followed by Chesapeake, followed by EM Energy, followed by Eclipse. This is a graphic showing these top 12 operators by average IP, and as you can see, they're fairly uniform across the way, and the distribution is mostly related to where these operators are currently drilling. Top 12 operators by average IP, this is where these operators are currently operating. So this is sorted. Red is the highest IP, average IP, and blues are the lowest average IPs. So taking a look at the distribution by operator, where these wells are drilled and where these IPs are reported. Ohio oil and gas production. So we're going to take a look at the summary of production 2018. This is one of my favorite tank batteries in Ohio, and apologize for having it in all these presentations, but it's a nice picture. Producing wells by year. So this takes a look at the ODNR database and the PR status, which within the database suggests that the well status is currently producing. And then also comparing the orange line is the number of wells that actually reported production volumes. I put this in here just to kind of show that we've We've got an enormous number of wells in Ohio. We still do. Over 50,000 wells are at PR status, and of those wells, 46,000 of them reported production last year. Production summary. This is oil production by year. 2018 oil production is estimated to be approximately 20% more than 2017. So this is a change. This is a trend. It's been a declining trend since 2015. 2018 production is up above where it was in 2015. So that's a reverse in that trend. On this graph, the darker green is the unconventional production, and the light green is an estimate of conventional production for this year. And the reason why it's estimated is because the production reports for the non-horizontal wells are not all in yet. So this will be updated next year, but this is a pretty good, as you can see, it's been 3.3, 3.2, 3.1 million barrels per year for the last 3 years, but 2018 is an estimate. Production summary, gas by year. 2018 gas production total is estimated to be about 35% more than 2017. As you can see, the unconventionals together in 2018 produced about 2.3 TCF of natural gas, and the conventional wells in Ohio produced about 50 BCF. For the conventional gas, again, it's an estimate, but it's a pretty steady number there for unconventionals, around 50 BCF a year. Or sorry, for conventionals. The horizontal gas and oil, the fourth quarter data wasn't in yet, so this is only the first 3 quarters of 2018 in the totals for the unconventionals, but I estimated what the fourth quarter would be based on what the first 3 were. So again, taking a look at oil production, this is kind of neat for a historical perspective to see where we are today. The highest recorded production in Ohio was about 23.9 million barrels in 1896, and we've never been close to that number since, but we're making our way back up. 2018 total oil production is estimated to be 23.4 million barrels. So my prediction is next year we will exceed that all-time number for Ohio as long as we have data. This is a historical compilation of data that was provided by Larry Wickstrom, and the data sources here prior to the early 80s are various and obviously not always complete, but since 1980, the data on this is pretty good. Ohio's aging wells. I always throw this slide in here. I don't want to talk about it too much, but the key point here is about 56% of the wells in Ohio are between 27 and 40 years old. So we have an awful lot of older wells here that are still producing. This is taking a look at the average annual oil and average annual gas by age of well. And this number, the younger wells, obviously those numbers are going to continue to get bigger and bigger. But the bulk of production in Ohio still is conventional wells as far as number of wells. And Utica wells in the state. So these are all Utica wells that are tagged as producing in the ODNR database. The company with the largest number of wells is Chesapeake. Now, of course, they have divested a lot of those assets, but they're still listed as the owner in ODNR, so that's why it appears that way. The next largest operator in terms of number of producing wells is Ascent Resources, and then followed by Gulfport Energy. And this just considers the unconventional wells. Utica gas by production. So this is a history back since the first quarter of 2013 when we started to compile quarterly production from ODNR. So this is the quarter-over-quarter change in production. The change in production from the first quarter 2018 the third quarter of 2017 through the first 3 quarters of 2018, the production growth is about 14% over the prior time. Utica oil production, as you can see, about the fourth quarter 2015, we started to drop off and then leveled, and then in the last 3 quarters, the Utica oil production has increased quarter over quarter. So it's about a 41% production growth from the first quarter 2018 through the third quarter 2018. Wells online by quarter, 18% increase in wells from the fourth quarter 2017 through the third quarter 2018. So we have 2,242 wells online today versus 2,035 in the second quarter. Class 2 injection wells, talk real briefly about wells that are disposal wells in Ohio and the source of those water and where it's coming from. Volume summary, 53% of the water disposed of in Ohio was considered in district, and 47% was considered out of district. 2018 volume versus 2017 volume, there was about a 25% increase in water that went into Ohio's disposal wells. And the total volumes disposed of in Ohio is 44.9 million barrels of water. And this is an estimate. There's some incomplete reporting in there, but that number is pretty close to what it's going to be when it's finalized. Top 12 injection wells in Ohio by volume. Taking a look at the operators here, Elkhead, Buckeye Brine, and Environmental Energy Solutions are the top 3 wells in the state. Looking at the volumes, the Elkhead well in Tuscaroras was over 3 million barrels. Of that well, 63% was in-district water and 37% was out-of-district water. Buckeye Brine, 93% in and 7% was out. And it's interesting to look at where the source of water comes from these. To note on here, Clearwater 5, Clearwater 3, those 3 wells in the middle of the pack there with the asterisks, they did not have quarterly volumes for the fourth quarter included in the totals. So this will adjust when those volumes get reported. Thank you. That's the end of my presentation. I appreciate you coming to listen, and I'll be around the rest of the meeting, and this presentation will be posted on the website if anybody wants to dig a little bit deeper into it. So thank you very much.
Thank you, Marty, for that informative recap of activity from 2018. I don't know about you guys, but I love his presentations every year. It's just incredible to see what's changed in this industry over the decades. So thanks again, Marty. Our next presenter is Timothy Knobloch, who will be providing an update on mergers and acquisitions and an Appalachian Basin roundup. Tim is president of James Knobloch Petroleum Consultants, Inc., based in Marietta, Ohio. Tim has been associated with the firm since 1997, performing reservoir analysis and economic appraisals, estimating and auditing of oil and gas reserves, providing litigation support, production analysis, oil and gas appraisals, and acquisitions and divestiture. He holds a Bachelor of Science in Petroleum Engineering from the Pennsylvania State University and is a certified minerals appraiser with the AIMA. Tim has been a lifelong member of the SPE and has co-authored technical papers for SPE Eastern Regional meetings on both production analysis and corrosion. Please welcome to the stage Tim Knobloch.
Well, good morning, everybody. I appreciate you being here today. We're going to make this as brief. I don't want to say brief, but we're going to move right along in this presentation. So I just say pay attention. What I'll tell you is that there was a number of folks here, and I see gray hair and thin hair in this room. So we've been around for a while, and we were still learning, and we still are learning today. So what's transpired over the past 8 years, we've been doing our learning quickly. And I believe there's still yet more to learn about the drilling, landing, completion, and producing of horizontal wells. Basically, the presentation today is going to, again, include mergers and acquisitions that occurred in 2018, and we'll look at some past folks who are no longer here. We'll give you an Appalachian Basin overview, talk about completion trends, look at where the drilling rigs have been, where they are at today. We'll look at production, do some regional comparisons. And this last one should catch your attention is the number of wells greater than 10,000 feet. Let's talk about money first. And this has really driven our industry. If you look back, and these two graphs start in 2014. And we Look back at 2014 for natural gas, and that's just the Henry Hub. So we're looking at $4 gas, basically average. We had a peak at $8 an MCF. Dropped down to, in 2014, end of 2014, we dropped down to $3, or down to $2. And now we're back up running that $3 level. We see a few peaks here and there, but folks, we got a lot of gas in this basin. Take a look at the WTI. On that fateful day in November 2014, we saw the oil price at over $100 a barrel. We took a landslide fall down to $50 a barrel, down to $30 a barrel. We've been running about $50 a barrel with some peaks in there. And we'll look to see what happens. I've given you the 12-month, 3-year strip and 5-year strip, but life changes. This is my tribute to maybe some companies that are no longer here, folks that have sold, or maybe companies that have gotten out of specific areas. But you can see some of the companies' names maybe you hadn't heard of before, whether it be the buyer or the seller, but some are gone. And I've tried to color most things in this presentation by red for Pennsylvania, blue for Ohio, green for West Virginia. These are all horizontal well sales for the most part. This slide is based upon information from Richardson Barr and E-Spectrum, or from public data. If you'd focus on the top 6 transactions, all of those are horizontal related sales. And you see the first one, Utica Resources, had bought the wells from PDC. Included about 30 wells, and they paid $40 million. All of that was Utica. Go on down to XPR Resources, who bought out some Rex wells in Pennsylvania, 61 of them, for $17 million. Penn Energy bought out some Rex wells, 71 of those in Pennsylvania Marcellus. Drop down to the next 3 in Ohio. Ascent bought from CNX, Hess, and I think it was a Utica group, $1.5 billion, 93 wells and a lot of net acreage. Encino made a large acquisition, $1.9 billion. That included about 920 wells, 980,000 net acres. And then Eclipse had bought it, or this isn't really a sale. It was a merger between Eclipse and Blue Ridge. I believe now the company name is called Montage. And those assets are in basically Ohio and West Virginia. I want to give a tribute, I'll say, to the folks at Diversified. They've really made a big advancement in 2018. That total on that chart is what, 24, 35, almost 40,000 wells in West Virginia, Pennsylvania, Ohio, Kentucky, and Virginia. They acquired a lot of wells and a lot of production. You can see the total value was about $4.4 billion for these acquisitions, and about 1.4 million acres. Or, excuse me, it's more than that. That has to be about 5 million acres. That bottom number is incorrect. I'll give you the end of the story here and all the facts that you'll see behind it. I said we were drilling better wells. I believe we are, and I believe we're completing them better. The thing that we shouldn't get confused about is the number of wells being drilled and the number of rigs that are drilling them, because it's really what we're doing with those rigs. We're drilling with less rigs. So we peaked out in about 2013 with 178 drilling rigs in the basin. We're down to about 75, and that's for about the past 3 years. We're drilling less wells, yes. We were drilling about 1,600 wells a year. Now we're down to about 1,100. But look at the lateral lengths that we're drilling. We were at about 3,000 feet. We're up to an average of around 8,500, but we're drilling wells of 20,000 feet or more. Not a lot more, but maybe a little more. Our stage lengths have gone from over 300 feet down to less than 200 feet. So we're stimulating more reservoir. We have a lot more stages. If we were to look at, I recall the Eclipse Purple Haze well had 124 stages in it. I'll say that's a tribute to the fine men and women that are in our industry to pull off wells like this. See that we have a lot more sand, 5 million to 24 million pounds, a lot more water, 3 million to 14 million gallons. Overall, better EURs. I caution you about averages. You really have to look at specific operators, specific areas. And we're seeing the idea of having restricted production on the initial period of the wells, where it's anywhere from 6 months to 18 months. Let's take a quick peek at those 10,000-foot laterals. It's happening in all 3 states. And this is, if you look at Ohio, for example, we have 328 wells that are in stages of either drilled, completed, or producing. That's in Belmont, Monroe, and Jefferson. In Pennsylvania, the top wells greater than 10,000 foot, we have about 346 there. Those are in about 14 different counties, but the top 3 counties are Washington, Greene, and Susquehanna. And in West Virginia, we're also not quite as many wells there, 170 in 11 different counties, the main 3 being Doddridge, Tyler, and Ritchie. Take a look at the bottom 3, and I just wanted to give you 3 specific examples. Ohio, a 20,700 foot lateral. There has to be some tension when you're running that casing and getting it cemented. We had a 20,000 footer in Greene County, and we have a 14,000 footer by Antero and Doddridge. And you note there at the bottom that SWN just reported that they had drilled an 18,000 foot in West Virginia. So we'll see what the future holds. Take a look at, this is where we started. I'll say in 2007, 2010. We had about 1,290 wells at that time. And you can see the breakdown up in northeast Pennsylvania, and that will always be that northeast quarter. We had 425, the southwest quarter of PA 290, all of mostly northern West Virginia, but had some historic horizontal wells in southern West Virginia, 510. And we had just 20 wells at this time, 20 horizontal wells in Ohio. We jump ahead, it explodes up in northeast Pennsylvania. We had another almost 1,500 wells up there. We had 750 in southwest PA, 90 in Ohio, and 500 in basically northern West Virginia. We still stay at the same level in northeast Pennsylvania, another 1,400 wells up there. We're up to 1,000 wells that were added in southwest, 750 in Ohio, and 700 some in northern West Virginia. The rig count has decreased. We're into 2015, longer laterals coming. So we have less wells being drilled up in northeast Pennsylvania. We still have about 1,000 wells in southwest Pennsylvania, which is an explosion, I'll call it, down in Greene County, Pennsylvania. Have 710 wells in Ohio and 550 in northern West Virginia. Look at 2018. We got 625 northeast Pennsylvania, 725 in the southwest corner, 615 in Ohio, and 535 in northern West Virginia. If we were to look at total wells by status, we have there's a total of 13,500 producing wells, horizontal wells in the Appalachian Basin. And you can see the distribution there. 6,200 wells northeast PA, about 6,000 in southwest PA, 2,750 in Ohio, and about 4,000 wells of different statuses in West Virginia. And you can see that of that 20,000, about 70% of them are producing wells. Let's look at by producing formation. So we've got the big, I'll say the 800-pound gorilla again, is the Marcellus. We've got 8,000 Marcellus wells across the basin, very few in Ohio. As you can see, we only have about 17 Marcellus wells in Ohio. When we look at the Utica, Ohio is the mainstay for the Utica wells so far. I've got them at about 2,100, 220 in Pennsylvania. The majority of those are in western Pennsylvania, but we are seeing testing of the Utica all the way up through northeast Pennsylvania as well, where you see that scattering of blue dots. And then we talk about the Burkett Geneseo is the other main horizontal play. We have 190 in Pennsylvania, 30 in West Virginia, and none in Ohio. This map should get some people's attention, is that this is the BCF per 1,000 foot, our EUR. So we've gone through every well in the Appalachian Basin, forecasted the 50-year reserves, equated the oil into gas, and the best area right now is up in northeast Pennsylvania, primarily owned by Cabot, and those are just some horses up there. This does not take into account the value for the NGLs, but you can see it's northeast Pennsylvania, southwest Pennsylvania, and we go from there. And you can't say that it's the same across a whole county. We vary. Look at the top three by cumulative. In Susquehanna County, Pennsylvania, 18 to 20 BCF so far. In the top three EURs are in Bradford, Susquehanna, and Wyoming, all three in Pennsylvania. 55 to 60 BCF, 50-year EURs. In the top three wells, BCF per 1,000 foot are in Susquehanna and green, 8 to 9.5 BCF per 1,000 foot. I give you your top wells by year, BCF per 1,000 foot. And this just gives you an idea of how things have changed over time. Now, Susquehanna up in northeast Pennsylvania, they just had some great wells up there. So you see that there hasn't been a lot of change in the EUR per 1,000 foot. And these are aggregate numbers for that county. But you can see in Bradford, that number has actually increased. We've gone from 1.8 up to 2.5. Lycoming, we went from 1.5 up to 1.6, which isn't a big change. Tioga, 1.1 up to 1.5. In general, you see a progression over the years of increases in BCF per 1,000 foot. If we look at the cumulative gas by area, in northeast Pennsylvania, that's accounted for 44% of the gas produced so far. So 34% of the wells drilled so far account for 44% of the gas. If I look at southwest PA then, 28% of the wells account for 24% of it. 16% of the wells that are in Ohio account for 15%, and northern West Virginia, 19%. And this presentation will be made available, so no need to take notes. Producing wells by county, we come down to a relative few number of wells, or a few number of counties that account for most of the wells. As Marty had pointed out for Ohio, the same is true in Pennsylvania. So up in northeast Pennsylvania, the number of wells starts with Washington County at about 1,500 wells down in the southwest corner there in red. We then shoot up to the northeast corner at 1,300 wells. Just go on down the list. Greene County, I look for that number to maybe come on stronger, and it may exceed both Susquehanna and Washington before it's all said and done. If we look at the number of producing wells by operator, and you'll notice here that EQT and Rice are separate because that's how they're reported, but we still show Chesapeake at 1,500 wells as being the leader, followed up by EQT with almost 700 wells in PA, 800 in West Virginia, followed by Range, SWN, Antero, and Cabot. The point that I make here is that 14 of the operators represent about 75% of the wells drilled and 75% of the production. I move on to the drilling rigs, the guys that get all this started. So I started in 2012. Before this, we had a peak number of about 173, as I stated before, but you can see that rig count has come down over time. And I'll give a salute to New York. They have no rigs running, and God bless them. So we've carried them for the past years now and providing them with gas, and you can see where this activity has occurred. And below that, you'll see the drilling companies that are supplying the equipment to do that, with Patterson and Helmerich and Payne having 40 rigs running here. But every rig is important to our industry. If we look at the breakdown of the current rigs and where they're located, you see that they're pretty well distributed amongst the different areas. Northeast Pennsylvania, 19, 23 rigs in southwest Pennsylvania, and you can see quite a few down there in Greene County. 17 rigs in West Virginia and 16 in Ohio. And this was provided by Rig Data. If we look at the rigs by operator, of course, it's EQT, Ascent, SWN, and you can see that the states are located in. On down through Cabot, Chesapeake, CNX, all the way down to the right-hand side of folks with only 2 rigs, and that's quite a bit of an effort, even with just 2 rigs. If we look at the wells by operator and where those rigs are active at, you can see that the rigs are pretty concentrated within just 2 or 3 counties. That's Allegheny, Greene, and Washington. Down for SWN, that's Brooke, Marshall, Ohio, in West Virginia, Susquehanna, and Tioga in Pennsylvania. I think everything else is pretty explanatory. Down to Seneca in the right-hand corner with 2 rigs. That's up in central Pennsylvania and northeast, Cameron, Elk, and Lycoming. I want to also give this is a good salute to these other folks who are just carrying 1 rig. If you're supporting 1 rig, you're still doing quite an effort. And these 14 operators have 1 rig, and I've identified those in blue, red, and green according to the state that they're operating in. This one you're going to have to compare from year to year. So if you look at Encino, and we've already made the change, and instead of calling them CHK, so this is Encino now. For example, there were 559 wells up through 2014. There was only 150, with their average footage length was 5,800 feet, 27 stages per well, about 800 shots per well, 9 million pounds of sand, 7 million gallons of water. Go to 2015, 2016, 155 wells, about 8,000 foot laterals, 39 stages per well, 990 shots per well. We're now up to 12 million gallons, and your sand concentration is about the same. Drop up to 2017, 2018, 83 wells, where our average footage is 10,000 feet, 60 stages of completion, over 2,000 shots per well, 18 million gallons, or 18 million pounds, and 14 million gallons. And you can just see that increase, more lateral length, more number of stages, more sand, more water. Let me move ahead. I go over to Pennsylvania, and you see basically the same thing here, is that as we advance, and I'll look at, let's just take a look at range, for example. So they had 1,100 wells, 4,600 feet, 39 stages. In 2015, 2016, they drilled 226 wells. Their average length was around 6,000 feet, 30 stages. If we advance to 2017, 2018, 188 wells, and they're almost 10,000 feet per well, 50 stages of completion. Funny thing about Pennsylvania is you don't have to report sand. So a lot of these wells are unreported sand and comes out from an estimate from Frac Focus. We look at West Virginia, you basically see the same kind of trend, where year upon year we're seeing maybe less wells, longer laterals, more stages, and the shots per well is increasing, and the water and sand is increasing. I'm out of time. So I'm going to quickly just get to the end here. You're sure? Okay. Thank you very much. So I'll go quickly here. So we look at, let's go Ohio. 4 counties account for 75% of the wells operated, producing wells. We look at the Pennsylvania, we got about 12 operators there that account for 75% of the wells. In West Virginia, just 4 operators accounting for 75% of the wells. Same thing on producing wells by county. I got 5 counties in Ohio that basically account for 75%. I've got 6 counties in Pennsylvania accounting for 75% of the wells, and you can see how the count changes by year for depending on the county. West Virginia, we've got about 7 counties accounting for 75%. These last graphs basically just show the change in activity over time. This is the one that would drive it home. We've gone from 2,000 to 2,500 feet up to close to 9,000 feet per well. And the lateral length, we're basically drilling we're down to 75 rigs. We've held that constant, and we're drilling about 5 million feet of lateral length a year. and the number of stages has increased. I thank you for your time. Done.
Thank you, Tim. Okay, well, I'm very excited to present our next presenters, as they're both my bosses. Our next presenter is Hardy Murkison. Hardy is the co-founder, president, and chief executive officer of Encino Energy. Founded in 2011 and headquartered in Houston, Texas, Encino is a private onshore U.S. oil and gas acquisition, exploration, and production company backed by a multi-billion-dollar acquisition partnership between Encino and the Canada Pension Plan Investment Board. Encino closed its first acquisition in 2018 with a $2 billion purchase of Chesapeake Energy's Ohio Utica assets. Hardy began his career in energy finance as an investment banking analyst at Simmons & Company International. Mr. Murkison earned a Bachelor of Arts degree from the University of Texas and holds a master's in business administration from Harvard University. Mr. Murkison serves as a director of the Coastal Conservation Association Texas Fund, an organization dedicated to promoting and enhancing coastal resources for the benefit and enjoyment of the general public, and serves on the advisory board of the Katy Prairie Conservancy, an organization focusing on land conservation, prairie restoration, education, and outreach. Thank you. Please also welcome to the stage Encino's Chief Operating Officer, Ray Walker. Ray Walker joined Encino in 2018 after retiring from Range Resources, where he served as Executive Vice President and Chief Operating Officer, where he worked alongside Encino's Chairman of the Board and former Range CEO, John Pinkerton. Together, they built Range into a $12 billion exploration and production company pioneering the Marcellus Shale. Ray also served in various technical management roles at Union Pacific Resources Corporation and Halliburton, and co-founded the Marcellus Shale Coalition, serving as the organization's first chairman. Mr. Walker holds a Bachelor of Science degree in agricultural engineering from Texas A&M University. Yeah. Why does that always happen with Texas A&M? I mean, what is that? Lastly, please welcome the Ohio Oil and Gas Association's president, Steve Downey, to the stage to moderate this discussion. Thank you very much.
I should check, make sure this is working. Everybody hear that? All right, great.
I don't think I have one. I'll just yell.
Yeah, or grab that one.
Here, I'll just do this.
There we go. You get to be the talk show host.
I can do this. Hardy, Ray, thank you all for attending, and welcome to Ohio and Ohio Oil and Gas Association. Ray was elected to our Board of Trustees yesterday, and we're really excited to have Encino in the basin and both involved in the association as well. So that's very exciting for us. Hardy, I think most folks know the lay of the land with respect to the Chesapeake assets, but can you tell us about Encino in general and what drew you to Ohio to make a $2 billion acquisition?
Yeah, sure. First, let me just say thanks to OOGA and thanks to everybody here for having us. It's really our first opportunity publicly to introduce Encino to the state of Ohio and to the rest in the industry. So we're glad to be doing that, really glad to be here. Look, to kind of give you the background on Encino, we're a private company. As Jackie said, we started about 8 years ago with the idea that there's a lot of change in the oil and gas business and a lot of volatility that the best way to make money for our shareholders was to take a longer term strategy than is normal in either the public markets or than most private companies can take these days. And so we started with a group of individuals as investors who were like-minded, and we started building a team that was the best technical and operating folks that we could find. We started very small intentionally. Think about the environment in 2011 through 2014. Things were pretty good in our business. And so we started slow. After the downturn of 2015, 2016, we made a strategic pivot and decided that given what was going on in the industry, it was time to expand our business dramatically. To do that requires a lot of capital, and so we went and found a partner in the world's third largest pension plan, the Canada Pension Plan, which is sort of the Canadian version of Social Security. It's a $300+ billion fund that has a specific focus on long-term investments across many sectors, including energy. And so together, we started with a clean slate and said, where can we find the best assets to build our company around? We looked in every major resource play onshore U.S., and clearly there were some really exciting assets in places like the Eagle Ford and the Haynesville, and certainly in the Permian. We looked hard kind of up and down Appalachia, including some things in the Marcellus. But ultimately, the asset that we found in Ohio checked every box from our perspective. Start with the state. It's just a great pro-business environment with a great population of hardworking, well-educated people. A huge resource in place in the Utica that, in our view, had kind of been overlooked, while the Marcellus and the Permian were getting a lot more attention. In Chesapeake, we found a counterparty who had done a fantastic job of assembling a great position, but for their own reasons, needed to focus elsewhere. And so there was a deal to be done on a great asset, managed by great people, and an opportunity to make it better.
Yep. Thanks, Hardy. I think the caller, in the background of that really helps immensely. It really helps us understand your motivation and really provides, I think, some additional excitement to the basin when you have an acquisition like that. It's pretty cool.
We're certainly excited.
Ray, I know most folks, I can imagine most folks know you from your work in the basin and your days at Range, and but what brought you out of retirement to do this? I mean, what were you thinking?
Yeah, that's a question I get a lot. And back about a year ago, I decided it was time to hang it up at Range, and you kind of get to that point in your life where you've done well enough, and had a whole list of honey-do projects that I thought might take me months to do that I accomplished in a few weeks, because I never had 12 hours a day to work on it, And after 3 months of pestering my wife at home, she basically decided I needed to go find something to do. And I've learned from a lot of guys my age that that's pretty common. So I actually had reached out to John Pinkerton, who's the chairman in Encino, and John's sort of a legend in the business and around Fort Worth, where I was living at the time, and said I wanted to have lunch sit at the foot of the master, figure out how to get on the right boards and maybe do some consulting or some ideas. And basically he hooked me up with Hardy, and pretty much met Hardy the next day, and I've been there ever since. It's a great group of people. It's a great business plan. It's really long-term based. It's an exciting asset, like Hardy referred to. It's been well delineated. It's got a lot of upside left in it. Ohio is much friendlier than Pennsylvania, so it's a great environment to work in and build a good team. And this has just been really exciting. So I joined the company back in September as Chief Operating Officer, and I think it's nowheres but up and forward for several years in the future. So we're excited to be here, excited to be a part of OOGA. We plan to play a big role in the state, and I'm looking forward to it.
Great.
Steve, I might just add, it wasn't that hard to persuade Ray to join us, because I think he looked at what we were buying from Chesapeake, and as one of the guys who's been primarily responsible for a lot of the statistics that everybody just saw in the prior presentation. Longer laterals, bigger completions, higher EURs per lateral foot. Ray took a look at what we were buying and said, I can do exactly that and do it well, and he is.
Well, it really is exciting, and I appreciate that background. We've seen a lot of press. I certainly have on the 2019 drilling programs, capital budgets of other companies, not only in the Utica but in the Marcellus and even in the Permian, the other basins. Without, I guess, providing any proprietary information, obviously, but what can you share with us about your plans for 2019 and what your focus will be? I know you have both wet and dry acreage. What your thoughts are with respect to the development of that.
Sure. I mean, Ray will certainly elaborate. I'll take a first kick at that. I think to start with, you got to recognize we're in a transition from Chesapeake to Encino, and that takes months to accomplish. So, in some places in the state, Chesapeake is still operator of record of some of the wells, and that's just a transition that'll happen over months. Ray and his team are pushing all the buttons, but making all the decisions as operator. And so as we take over, we start to obviously have more and more influence on that development plan. But to be clear, virtually all the wells that we'll drill in 2019 were planned by Chesapeake before we arrived on the scene. With that said, we're planning and actually executing major changes in terms of things like completion designs, and over time we'll extend lateral lengths as well. For this year, with the well program that Chesapeake had planned, we're continuing to drill with 2 rigs. We've got 2 completion crews and may add a 3rd at various points during the year. That's not any major change from the activity levels that Chesapeake had, except for the fact that we're just applying a much steadier pace. So whereas Chesapeake would move those crews and equipment back and forth between Ohio and Pennsylvania, we'll keep them here in Pennsylvania, and we'll basically focus equal amounts of capital between the dry gas and the wet gas areas. That'll fill pipes on both sides of our systems and grow production this year at kind of our target rates.
Yeah, there's not a lot I can add to that, but I think the focus this year is really going to be, like Hardy said, working on completion designs and optimizing what we inherited from Chesapeake as far as planning and the wells that are ready. We're going to be able to add some lateral length, more proppant per foot, more fluid per foot, a lot of those sort of things, new target levels, things like that we're going to be focused on. Of course, building the team up and really getting ready for the future. And of course, the one thing after 43 years in this business I can tell you is really hard to predict what next year looks like, what the year after that looks like, because the commodity prices are just impossible to predict. But I think the advantage that we have is we have an equity partner who has a really long-term focus, and that's one of the main things that really attracted me to Encino and the whole project was, we've got the ability to look at this over multiple years, if not decades. And we're not driven by having to flip this thing in 3 or 4 years. We don't have to worry about what the public markets think right now, and all those sort of things. So it really does allow us to do things the right way for the right reasons. And I think we're going to focus a lot on that this year, is putting that plan together, developing a long-term approach to the asset. And like Hardy said, I think you're going to see us a whole lot more steady, a whole lot more deliberate in what we're doing going forward, and getting involved and to do that over the years.
That's well put. I think the only thing I might add would be we've set up a company that provides a lot of stability for our team to go execute on a program like that. We hedge very actively to try to reduce commodity price volatility, make sure the cash flow is there to fund our program. We've capitalized the business with a lot of equity and not a lot of debt, again, just to provide stability. On the other hand, the plans are always going to be dynamic, and so while we've got 2 rigs drilling in the field right now, I can tell you we learn new facts every day. For instance, We took over drilling and completion operations less than 5 weeks ago today. And on our first drilling pad, Ray's team came out of the gates by setting a new Ohio State record for lateral feet drilled in a day by drilling over 7,000 feet in one day. So when you start surprising yourself in ways like that, you have to adjust your plans to some degree.
But one thing I might suggest is, I forecast prices with my Magic 8-Ball app.
Yeah.
So you may want to download that because I think that's pretty cool. One of my concerns that I've had, and I've expressed this even in the Board of Trustees meeting yesterday, was the continual consolidation of not only our shell operators but also the conventional operators. And I think Tim's presentation and slide really kind of set that forth again for me. What do you forecast, or how do you see the outlook for the basin? Do you think there'll be additional consolidations and flipping of operators, if you will, and just what are your thoughts with respect to that?
Yeah, I think we absolutely believe there will be for a couple of reasons. If you just look at the basin as a whole, and this is not unique to Appalachia, it's true probably in every oil and gas basin across the country. You got a lot of relatively small companies, and these days relatively small can be billions of dollars in size, because every well we drill, as laterals get longer and completions get bigger, is $10 to $12 million a piece. So the numbers get really big, especially when you're pad drilling. So scale becomes much more important. It's really hard for a small business to manage projects like that. These pads in states like Ohio now look like the offshore platforms of 30 years ago in the Gulf of Mexico. And so it's a big boy's business. I think the pressures on the industry to consolidate are real. You've got a lot of private companies owned by owners that don't have enough capital or don't have enough time. The private equity funds that now own so much of our business can only hold a company for so long, usually less than 10 years. And so they will be sellers, and it's a question of who will be the buyers. On the other end of it, in the public markets, investors are really clearly signaling that what they want is larger, better capitalized companies that are focused not just on growth, but on shareholder returns. And that translates to consolidation of a bunch of smaller companies into a few bigger ones. We think we are probably better positioned to participate in that than just about anyone, given the way we've built our business, the way we're executing our business, and the way we've capitalized it with our partners.
One last question from me, and we've seen the logo, up on the wall on the screen, and is there a significance to the large oak tree, and how did you pick Encino?
Sure. So there is significance. The oak tree there on the wall, and behind us, nope, not behind us anymore, on the wall. There we go.
It's right in front of us. Yeah.
It's everywhere. It is a traditional sort of symbol of long life and stability. So that was clearly a part of our thought process as we named and built the company. That being said, when you start a business, the first thing you have to do is go online and see what names are available. Every oak tree name on earth is already taken, I'm pretty sure. There's a lot of Hispanic influence in our culture in Texas, and so we use Spanish words for things all the time. Encino simply means live oak in Spanish.
Jackie, did you want to open it up to the audience?
Good morning. George Alcorn with Utica Resource Ventures. This is for Ray. Could you elaborate a little bit more about how you're going to evolve your completion operations going forward with your new asset base?
Sure. Just a little bit. A lot of, one of the things that attracted me to Encino is they put together a really first-class team of reservoir people that spent a lot of time building basically some predictive analysis around machine learning, and they took a lot of data from all across the Utica, and basically were able to let the computer predict what an optimum job size and stage spacing should be. We have implemented some of those recommendations to this point and already seen 30-40% increases in IPs. It's as simple as the right size job for the rock, you know, is the best way to say it. So we're going to continue to engineer that a lot like I did in my past career. Is, you know, you used to hear me say publicly the Marcellus is not the Marcellus everywhere. And the same thing holds true in the Point Pleasant. It's not the same everywhere. And so I think we'll evolve and really focus on the data and the technical designs that best fit that rock that we're working in. In most cases, that means more volume, more proppant, different stage spacing depending upon, you know, the parameters in the rock that we see. So that's a lot of what we'll be focusing on this year to get that lined out. But, you know, like I already said, we just took over drilling and completion operations on February the 1st, and first well out of the box on the drilling rig, we set the record by over 1,000 feet a day, and then we drilled the second day we drilled over 6,000 feet. So it's the first back-to-back over a mile each day that's ever been recorded in the basin. We've seen similar stuff on the completion side, you know, as far as just performance of what we've done.
That makes a good point. I mean, our background is people from companies that have really used data intensively, and we're building out our own systems to do that. So what we've done thus far is looked at you know, every well that's been drilled and completed in the Point Pleasant and learned from that. We're starting to learn from our own wells right now. It's really clear that, you know, how much of the lateral actually stays in zone, in which in the case of wells Ray was talking about was 100%, really impacts production from those wells. And it's pretty clear that generally speaking, you know, more slick water fluids and more proppant are real positives. But as we refine that, I think we'll find ways to make more productive wells, but also less expensive wells.
Hi, good morning. Good morning, gentlemen.
Good morning.
Aaron Martinez with Steppen Chemical. As my question really revolves more of a complementary piece to your engineering and asset management business. What type of technical challenges do you see here in the basin, Marcellus, Utica, Point Pleasant, thing like that, that would be focused more on overcoming technical challenges focused on chemistries? Just a general question. Thank you.
Wow, that could be a loaded question, right? I think that, you know, there's different levels of technology improvement over time, and I didn't get to see the entire last presentation, but you saw definitely some of those results, you know, and how everybody goes up and to the right, or in your case, up and to the right. As you make big improvements, you make big changes, you know, going from gels to slick water, from, you know, 1,000 pounds per foot to 2,000 pounds per foot to 3,000 pounds per foot and so forth, and you tend to go up that curve. Bigger is usually better in our business until it's not, right? And so you have to manage that point. I think in some areas in our business, we're way up that learning curve, and in what we're gonna see is little tweaks and improvements going forward. I think water chemistry is something that, you know, we've got some people already looking at that a little bit. Water chemistry in reaction to the rock. Point Pleasant is not as critical as some of the shales, and, you know, that you hear about in the Eagle Ford and West Texas, and, you know, even the Marcellus to some extent. But I think there's going to be a few things on the chemical side that we can do going down the road. I don't see them as major technical improvements, but I do think those tweaks will continue to happen. The good news is, you know, this basin is pretty well delineated. Everybody's kind of staked out their position. I think what you're seeing now is companies are beginning to cooperate better technically. And so we're exchanging technical ideas. Hey, you know, why did you perforate this way? And why did you run these chemicals? And, you know, we're all getting answers from each other. And so I think that's going to help going forward. But, you know, at this point, we don't really see big scaling problems. We don't see a lot of the issues that, you know, they have in the Permian Basin, for example. There's a lot of big issues out there that don't get a lot of publicity. But I do think we'll see, you know, we'll continue to work on things like that as we go forward. I don't know if that completely answered your question, but closest I could get.
What do you foresee in the line of recompletions of some of the older horizontal wells?
I think there could be some possibilities or potential there. You've seen it attempted in a lot of different basins. Historically, I would tell you, as a guy that's grown up around fracking, doing refracts or recompletions generally only work when somebody messed it up really bad the first time, right? And I think there are certainly cases like that. I think there's also, you hear a lot of press these days about the parent-child relationships and, frac hits and, things like that that are taking place all across the industry as we go back and add more wells to an existing pad, for instance. There's some ideas floating out there about maybe you just go back and refrac or re-stimulate the parent well at the same time you're completing the new wells, and perhaps all of that added stress and pressure creates a more complex fracture system, makes better wells overall, instead of the parent well trying to thieve some of your frac job. So there's a lot of things like that that I think the industry is going to experiment with. We may try that, maybe not this year, but I think coming forward, we potentially could put some of those in practice and see what happens. But I do think it's pretty good potential.
Well, gentlemen, thank you very much. It's always nice to associate, a face and a personality with a name and a company, and I think this has been wonderful for us. Really appreciate you all doing this today. Also, welcome again to Ohio and the association. Looking forward to working with you guys.
Thank you.
Yeah, thank you very much. We're excited to be here.
Okay, as most of you are already leaving, this concludes business session 1. Now I invite you all to attend one of our 2 breakout sessions. The Ohio Oil and Gas Association's Producer Committee is hosting a discussion on the ODNR Orphan Well Plugging Program in Region 1, while the Ohio Oil and Gas Association's Midstream Committee is hosting a conversation about pipeline safety through the Mega Rule in Region 3. We will gather back in this room after lunch on your own at 1:15 for business session number 2. Lastly, as a reminder, please find your way through the security checkpoint by 11 a.m. Thank you.